Good day, everyone. It's Maru from Financial Liberties, and thank you for joining me on this live stream. Today, we're going to be discussing gold, silver, and the miners in general, and kind of giving our long-term overview of the mining sector as well as the precious metal sector, what's been happening lately, the drivers that have been driving the metals higher, and kind of a general discussion on where we see things going in the future. So I'm just going to give you a quick background who I am. My name is Maru. I'm from Financial Liberties. I had a website called Golden Fortunes back in the first bull market when I was covering the precious metals sector as well as the miners. That was back in starting in 2005 until about 2013 that I was covering the metals and the miners. So during that time, I was self-taught originally. Had a friend from the tech days who was going to work for a junior mining company in about 2004, beginning of 2025. He told me about the metals and why he was going to work for this junior mining company. So I started doing some research into why precious metals were entering a long-term bull market, understanding the Federal Reserve banking system, central banking in general, fiat currencies, and that led me down the road of becoming a precious metals gold bug. And so that's where I started it. I was pretty much self-taught initially, and I got to ride that whole bull market from '05 through to 2013. And towards the end of it, in 2010, I met a gentleman who was known in Canada and started Stockhouse. He was thinking, him and I were talking about starting a newsletter. He started it and I joined him. And with him and his connections, I ended up writing a subscriber-based newsletter about the precious metals and the miners. We started that pretty late in the cycle. But because of him, I was able to start speaking at conferences like PDAC as well as Cambridge House. I was published on articles on various different metal sites. And I got to see that whole bull market play out, especially when it came to the junior mining and exploration companies, which I kind of like to think is my wheelhouse when it comes to the miners. And that's something we'll be discussing later on in this live stream. So as you can see, I just created a little collage of some of my past articles, publications, speaking engagements, and that's kind of it for that. So I want to get into a bit of where we are in the metals market right now with a bit of an overview. This chart actually shows, I'm just going to move this over so it can be seen a little more. So this chart's showing how gold has performed over the S&P over the last 25 years. Most of these charts are from 2000 onwards. And you can see from here, even though the S&P kind of lagged for quite a while, and it did start taking off in 2012, right after the great financial crisis, and has risen quite a bit. But when you compare it to gold's run in 2001, gold was around under 300. Let's call it about 280, 300. And by the time we hit the top of the 2011 bull market right here, gold had gone up to almost $2,000. So from, let's call it 300 to 2,000, you have almost a 7-fold increase. So then it obviously went into a bear market, and I was writing about this back in my newsletter saying this is going to go into a heavy correction, but I kind of suspected, and I was saying that this could be the end of the bull market for now, and we could be going into a bear market. So I wasn't really doing a lot of recommendations at that point. And in fact, about a year later, I stopped writing the newsletter just because I knew we were in a bear market and there was no point in providing coverage on it at that time. Now, that being said, I am providing coverage again. I have been speaking about the metals for the last few years, last year or so more actively in the public space, and now doing a lot of videos and interviews with other experts in the space. But as you can see, gold did go into a bit of a bear market here while the S&P continued to rise. And then I would say 2018, 2019, it was coming close to an end. Then it started taking off a little bit, but nowhere near the highs of the 2000. It was touching that the last 2 years. And the COVID hit, came back a bit. After that, gold just really started taking off. And I'm going to explain why I think starting in 2021, 22, really started to lift the gold market in general and start a new bull market, which I suspect started when gold finished its consolidation period under 2000. Kind of that low during that time was about 1650. But let's just call it on 2000, I'm using round numbers here. If we get to see the same performance of a sevenfold increase from the 2000 to 2012 run, and we take it at 2000, which was overhead resistance in 2011, and breaking above that, that's the new bull market range. If we do a sevenfold increase on 2000, I suspect gold could easily go to 14,000. Other analysts are calling much higher. Some are being very conservative. But just at $5,000 on gold where we are right now, today, it seems like gold is primed to move higher over the next 5 to 7 years. So if a bull market lasts 10 years and we started in 2021, 22, then I suspect into 2030, 2032 is when this bull market will be finally over. And we still got about another 5 to 7 years ahead of us. Even here is another chart just outlining the same thing. It's showing it a little more clearly. But you can see, it had this great run. This is where I was involved, 2011, 2012, it peaked out, corrected, came back, S&P was still kind of rising. And then when this got taken out in 2019 is when I think it really started, but this acceleration of over 2000 in 2021, 22 range, that was where I think it just broke out. And you can clearly see starting in 2024, that the metals really just did take off and explode. And silver's done phenomenally well over the last year, as many can see, following the silver price. So that's it for the S&P comparative. Just to give you a bit of coverage right now, in 2025, silver was probably one of the best performing asset classes, well over 100%. In fact, it was actually 138% gain. Rare earth stocks did very well. Uranium stocks, then gold itself also doing very well last year. Emerging markets, ironically, have done very well. And I live in Mexico. I moved here over 4 years ago. So a lot of the coverage I'll be doing with this channel is on the metals, the miners, but also a bit of a focus on the Mexican miners because I'm here. And I also have another channel called Seeking Liberties in Mexico, where I do coverage on the Mexican economy in general and why I like it here in Mexico. So if you want to learn more about Mexico, you can go visit that channel. But you can see here the NASDAQ did 22%-ish. S&P did 16, which beat inflation, but wow, not by much. Ironically, Bitcoin didn't do much last year. It sat and consolidated pretty much for the whole year. In terms of top asset classes by market cap, gold is now cumulative in the gold sector itself is over $31 trillion. Probably even a little more because it's a bit older, so I would suspect it's probably more like 33, 34 trillion. Silver, a lot more than the 4.7 trillion, probably well over 5 right now. But it shows you that silver in the last 2 months has overtaken Nvidia's market cap of 4.5 billion, Google's of 4, Apple's of 3.8. So cumulatively, the gold and silver market by market cap are well above all other stocks in general. Not to say that it's bigger than, let's say, the tech sector cumulatively, but it's great to see gold and silver be at the prices they are. And again, I think we're early stages in this bull market, maybe a few years into it, but this is where the traction gains, the institutional investments come in, and the miners are ripe to even go much higher. In terms of who's the biggest driver of this precious metals bull market that started a few years ago, and we suspect it's central bank buying that started it all. They've been net buyers for the last few years. We've had emerging market central banks being actively buying in the space, and a lot of treasuries are getting dumped since then. That trend I don't suspect is going to change. So, as people diversify out of the U.S. Treasury market, they have been going into gold and now silver. And I did a podcast a week and a half ago with Jay Martin from Vancouver Resource Investment Conference, or VRIC Media. And him and I were talking about central banks being the net buyers and pretty much starting this bull market. And I pointed out that I think the big catalyst that started it all was when the war broke out between Russia and Ukraine, and then Russian assets in Western banks got seized. That really, to me, was one of the bigger catalysts, showing that, your assets are no longer safe in a bank if you oppose Western views. And ever since then, the metals have really taken off. And my suspicion is we are seeing gold and silver now come back as monetary metals. They're coming back into the financial system. They've been doing that for quite a while now, especially when gold became a tier 1 asset class on banks' balance sheets. And that was starting, I think it was in 2016 that happened. But that, to me, was kind of the big catalyst, the canary in the coal mine, that things are not right around the world. There's a lot of geopolitical risks, and gold has been the benefactor of that. So that's kind of where we're at. Another thing that happened was also China, the U.S. government putting tariffs, China talking about restricting critical minerals for delivery into the global marketplace, needing it for themselves. China had a great grip on the critical minerals, and as a result, this has started a whole commodities boom market, not just in gold and silver, but all of the commodities and uranium have been on fire over the last year. And I don't see that trend changing soon. Can we consolidate, correct a little, and then resume the trend? Absolutely. That's what I think is going to happen. But that being said, there's some great upside still here on the metals. So critical minerals are generally used for a lot of industrial purposes. That's the biggest demand. And you can see on this chart, these are copper. I mean, they're just projecting 2030, 2040. The demand is just going to continue to increase. Lithium, the same thing with the solar industry and lithium batteries. They say by 2040, there's going to be a 4x demand for it from where we are in 2024. Then nickel, cobalt, graphite, rare earths, all just increasing. So this is a 10, 15, 20-year bull market for need of these minerals. And it starts now in terms of making discoveries, extraction, building North American supply chain, starting right from the miners to refiners. So this trend is just starting, is what I'm saying. And it just started 1 year ago. So we're very, very early stages in this bull market. And a lot of gains have been made. Can we see corrections? Yes. But there's still a lot of gains to be made in the future, I believe. Just to give you another example, in 2025, there were 60 additional critical minerals, or 10 new critical minerals added to the critical minerals list, and 15 rare earths. So this is from the U.S. Department of the Interior. a chart saying which minerals have been added, and you can see cerium, dysprosium, palladium. A lot of these I don't know, but the biggest ones that I see that is of most importance is silver, and that has been added on, which is why we're seeing a big demand in silver right now. Now, the other thing that's been new to this bull market in the last 6 months to a year that hasn't even happened in the last cycle is the biggest new investor that has come up into this mining space, and that is the U.S. administration is now taking stake in several miners, MP Minerals, Lithium Americas, Trilogy Metals. I think we're going to start to see more public-private investments coming from the private or the public sector from the U.S. administration into these critical mineral companies, miners in the U.S. If you haven't paid attention or don't know, last month the U.S. administration has announced a $7 billion refinery project, one of the biggest refinery projects being built outside of in Tennessee, and that is probably going to go through. It'll take a few years to build, but they're ramping up for excess or extra demand for these minerals, but extra supply is going to be brought online, and now we're talking about additional refinery for these critical minerals at that processing plant in the US, because China was the biggest refiner of these minerals. They can no longer rely on China as a supply chain source. So the US administration is now taking it upon themselves to secure their own metals and build the mining infrastructure as well as the refining capacity that's going to be needed. So that's a big change in the market. And I think that trend continues not just in the US, but globally, where you will start to see in Canada, the Canadian government talking about additional investments in the mining sector in Canada. And I'm from Canada originally. We are the biggest mining hub of the world. And I'm going to explain that a little further when we talk about mining stocks. So here's just World Economic Forum, just another article saying from minerals to megawatts, the resilience, building resilience for EV, data centers, power grids. We're going to be going through a major infrastructure change in terms of the power grids globally. I was just on a podcast talking about it for Mexico in general, but this is going to be happening globally, upgrades to it. So as we move more to the demand for energy, that's the plumbing of the global economy, and we're seeing a transformational change. Will solar be a part of it? Absolutely. Will it be all of it? I don't believe so. I think immediately we're seeing a surgence in natural gas, but uranium is going to be a big player in some of these grid level build outs, especially for the data centers and stuff like that. So we're going to start to see more and more modularized uranium plants come on board very soon over the next few years. Let's just go talk about gold itself and the price. As you can see in 2022, 2023, gold was just kind of in this sideways trading range between 1600 or just mid 1600s to 2000. Tried to butt up here, pulled back. Tried to break out again. It almost did and pulled back, consolidated. And then in the fall of 2022, you can see it taking off here. 2023, it was starting to make a higher trend line. Wasn't going back into those 1600s. 2000 was holding. And then it pulled back one final time in the summer of 2023, and then it broke out above it and has not looked back since. So this was a confirmation, breaking above 2000 right here, holding it, and then in 2024 in March, April timeframe, which is when I started to get really excited about it, seeing breaking out. We were talking about it quite a bit, going up to 2400, consolidating, and then you can see it just kind of stair-step laddering up in a bull market, with a bull flag pennant, bull flag pennant, bull flag pennant, and now it's just a breakaway right here. So, going into the elections, it ran up to about 2,800, pulled back to 25, 26, and then since then, with what's been going on in the U.S. and geopolitically, the metals haven't looked back. We've entered in another inflationary environment, and that's another catalyst outside of central bank buying, geopolitical risks, inflation risks. These fundamental factors that have driven the gold price up over the last few years has not changed. Nothing has really changed. In fact, it may get worse. And my belief is, the metals are coming back into the monetary system. We will see two things happen: a monetary crisis at some point, a loss of confidence in the US dollar, which will catapult it further, less buying of US treasuries. As you may know, the US administration is now talking about stable coins and introducing that. Tokenization of all assets. Here, let me just grab a drink of my coffee. That's going to be another major driver. So none of this changes. What does concern me is this vertical ascent that we started seeing pretty much this past summer. Right here, July, August, it really just started taking off into the fall. Now breaking above 3,400, going all the way up to almost 4,300, pulling back slightly down to 38, and then taking off again, where we're at January 21st today, and gold is flirting with 5,000. I mean, literally dollars away from 5,000. And as I mentioned, this does concern me. When I see things go parabolic, I don't like to see that. A nice 45-degree angle is a very steady comfort zone for the metals. So as there's this green line here that I've driven when it started to break out, and here's the test of it. So I extended from here to here. It came here, pulled back a little, retested that green line. So that to me right now, is the support line that we're going to continue to see. As long as gold touches here, it breaks, keeps going, touching it, bounces up, keeps going. As long as this green line, this one here, holds, the bull market is good. The moment it breaks below it, and I suspect it could happen at some point, I think we go much higher from here before this green line gets broken. But if it does, then this black line here is, this one I'm highlighting, will become the next support level. So even if gold continues to go higher, and let's say it goes to 6,000 in 2026, which is a realistic target, then at some point, if we do get a major correction, this line will become the next support line. I don't think we'll see this longer term trend line get touched anytime soon, but the green line is what I'm looking at for support. If it does break below that, this black line here is where once it touches that will be the next good buy opportunity. So we'll be covering that on this channel as well as our subscriber-based newsletter. So you may want to sign up for the free newsletter on the Financial Liberties website, but we do have a subscriber-based newsletter where we go more in depth into some analysis on the metals itself as well as the miners. Silver, the same thing, but the rate of parabolic move really started in November, December timeframe. So as you can see, all of 2025 just going sideways, churning sideways between 30, 35. Finally, this past summer, it started to break out above this 35, kind of pulled back August, and then September came when there's a seasonality to it. And I'll talk about the seasonality a little bit in a bit, but September, it really just started taking off. So we've seen it here go into October, pulled up almost to over $50, had a bit of a pullback, went as a flag, a bull flag, pull up to 55, retest it, held this moving average, and then kind of since the end of November, beginning of December, it just started taking off. And this is a bull market now. Now it's gone literally not even 45, it's going parabolic, which again concerns me, but it is what it is. So you can see here a big move up almost to above 80, a pullback into the low 70s, then a move up again, pullback, and then a breakout again, pullback, another breakout again. Will we see these pullbacks? Absolutely. This blue sloping line is going to be the support line, so anytime it touches that, you may want to consider a long. We've gone very extended, so at 103, I think it's going to go higher, personally. But if it does pull back, I'm okay with it, because more than likely it'll pull back into the 90s before it retests it and goes higher. My suspicion is over the next few months, we will probably see 115 to 125 on silver. For the March contract, 125 is looking like a lot of call options are being put on there. So that's something to pay attention to. So that's it for now. But this green line acts as support. Longer term, this red line is a long-term support. We need, for it to go back to 55, there has to be something fundamentally wrong with the silver market, and I don't see that happening. Can we get a pullback into mid-70s? Very possible. I'm not ruling it out, but I'd be very aggressively buying that and the miners for many reasons. But that's kind of where I'm looking at. But before that, before we even see 70, I think the better chance is to see 120, 125, then maybe pull back into that $95, $100 price range and hold. As long as $100 holds, which I think it will, the miners are going to make some phenomenal money. So, just to get into a bit of the factors that are driving the silver prices, gold initially always rises, silver lags, the miners lag silver, and then the juniors and explorations lag even further. So we've seen silver rise. There's a lot of fundamental drivers driving the price higher. And a lot of it is really tied with gold as well. So there's also, first of all, there's the devaluation of gold, of the US dollar against other currencies. The Mexican peso has strengthened quite a bit. And global debt mounts encourages investors to diversify away from the US dollar and US dollar based assets and into hard assets like metals for a safe haven. That's the big one right now. And central banks, obviously, as I discussed, has been the big driver. But there's ever growing demand for silver coming out of India, China. Industrial demand is massive. And I'll do another video on the drivers of industrial demand for silver. But Samsung is talking about their battery technology. I was just watching a bit of a video on someone talking about the U.S. Army replenishing missile technology, and it needs a lot of silver for the high-tech, big load missiles. So this is just not a solar panel story anymore. It's much, much more than that. But that being said, industrial demand for wiring and electronics, solar, robots, EVs, internet towers, phones, it's just not going to stop. Now, there was a severe undervaluation of silver compared to gold. Not even a few months ago, the gold to silver ratio was 80. A year ago, it was 100. Now we're probably 55, 60-ish or so. And historically, that gold to silver ratio had gone down to 30. But when you talk about metals in the ground versus gold, the natural earth ratio is about 15 silver ounces per gold ounce in the ground. So will we see a 15 to 1 silver to gold ratio at some point? Very much possible. So I'm not going to rule it out. At 30 to 1, that pretty much means another double on silver, even if gold doesn't move in price. And I suspect we will get there over the coming year or two. Shrinking supply deficit, huge bullion bank naked short position on it. And I'll discuss that very shortly, very quickly in a bit, but I don't want to get too in depth into the short position on silver. And we are literally seeing a short squeeze right now on the bullion banks, and the demand for physical silver out of Shanghai is super high. Not just Shanghai, Middle East, India, it's all over right now. The demand is all over the globe for it, and that's not going to change. But yet, mining supply has continually been lagging versus demand, and deficits have been growing in the metals inventories, which is why the silver price has been going up. So as we see, more investors are now flocking into it. That's been one of the big drivers, I think, over the last 2 months. The industrial demand story started out a year ago. The critical mineral story was more earlier in 2025. But the investor demand has just really started taking off in the last 2 or 3 months. And I'm seeing growth on some of these forums that I help moderate and post in on Facebook, Reddit. Just more and more people are looking at it, and investors are now scooping it up. They're even trying to restrict metals in various coin forms. But the refiners are at capacity, and they're not even taking scrap silver anymore for refining. They're focused on the bars. So that's kind of another driver for silver, is you're just seeing a major investor demand coming in. Number of mines beginning to run out of silver. No new reports of new finding sources of silver. Even if that does happen, it takes years. So hopefully we start to see mine supply increase. But grade levels have been decreasing in general. And we're going to have to do a lot of major discoveries to replenish what's already been depleted. New mines have to come in to supply this market. If it does not come in a timely manner, the silver price goes up, bottom line, because the demand is there. So at some point, will we see additional mine supply come on and exploration and finding new mineral resources? Yes, but these take a long time. I've been analyzing the mining sector for 7-8 years during that whole last bull cycle. I understand how the cyclicality of the mining sector works. And even to take a mine from initial discovery or initial drilling to discovery takes a few years, to the feasibility, then to get the permitting to put it into production, and then finally raise the capital to build it and put it into production. You're a 10-year cycle. So this is why I say this is a 10-year bull market in the metals, but even in the miners. The best gains are going to be made, in all honesty, right? They've been made already in the last year in the existing silver producers, but that'll still continue higher. But the best gains are usually made where we are right now in the cycle, 2-3 years into it. Demand is there, fundamentals have lined up, supply has to come. And you don't get supply until you actually get increased mine production and you get more discoveries. And that's kind of the wheelhouse I like to look at, is the companies that are expanding mining production, as well as the companies that are exploring for new additional mine discoveries. So big banks have poured many billions into gold and are now shifting to silver. Just 1% shift from gold to silver from big guys will cause the silver price to shoot up. And listen, $120 could look very cheap in a few years. Like I've heard other analysts talk about $300,000, $500,000 silver. Could it happen? Absolutely. I don't want to put a price projection on it. I'm just following the trend. And until the fundamentals change, the bull market is still good. And where the price goes, I leave it up to the market. I'll follow the price charts. I'll do the technical analysis. But you really, that may not even apply right now. Like, I mean, you can look, I do like to do charts and look at technical analysis. But when you lay the fundamental analysis on top of it, the fundamentals are much stronger than what even the technicals are showing right now. So, so this is why I'm bullish long term, the metals, but the miners is where I think the best opportunities are right now. So that was an area of expertise of mine, like I had mentioned. So this is kind of the chart that I created a few days ago. And I'm looking at the S&P compared to the TSX Venture, the TSXV, which is a venture exchange. That's where all of the junior miners and exploration companies are on. The majors are more or less on the TSX or the US listed exchanges. So if you're going to be looking at the junior mining sector, which is the wheelhouse I like to look at, then you really have to look at the TSX Venture Exchange. There are some companies listed on the Australian exchange, but most of them are on the TSX Venture, and then they may have dual listings, whether they're in the Frankfurt Exchange in Germany or the OTC market in the US. So those are the other two ones that you can look at. But primarily, if you've got an account in Canada and you've got access to the Canadian markets, I think we're going to see some explosive growth in the venture exchange. And they've already gone up 100, 200% already, I think. But that being said, if you take the S&P and divide it by the TSX Venture, this is where we're at right now. So you can see this last bull cycle, which here it's 2003, let's say, went from this range at around, I'm going to say 600 to 3,000. So 600 to 3,000 is a 5x move. Then obviously we got the correction into '08. Ironically, that was the big correction, and then it pulled back up. But a lot of those companies still went on to make higher highs in this time frame, but all of them didn't. So what the story is telling you is, in the early stages of this bull market, the juniors and the discovery plays make the best moves, and that's here. Once you get that correction, they'll get slammed down. And trust me, if we get another '08, '09 correction, yeah, you could see 70, 80, 90% loss in the value of those juniors and explorations. I went through it during that whole time frame myself. I see in a portfolio I grew about 200-300% in a few years. Literally get wiped down to where I started or less. But then it did all recover. I don't think we're going to get this major '08, '09 correction crash this time around. But will there be a catalyst that corrects everything? Absolutely. Could we get that type of a crash scenario again? Possible. Not on my radar right now. So why I'm bullish is you see this move here where 2021, it went up, came back, consolidated, and then into this March, April 2025 timeframe, it really started to take off this summer. So my point is this summer is really where the junior and exploration companies started to get a little love, and we're only about 6 months into it. As you can see, it has risen already, but once this overhead resistance gets taken out, and it is moving on strong candles here, you can see that. I suspect from this 600 low here, if we get another 5x move, we're going back up to 3,000. So it would not surprise me to see this from here, from this 600 range, go up to 3,000 where it was the last cycle high. I think it's coming. And it would be literally like this move we're seeing right here. So it moves up, pulls back to the blue moving line, tests it, goes back to the top of the Bollinger Band, goes right back to the blue, slightly under, goes back up, and then takes off again. Whoops, let me just get that back. So will we see that here? Yes, we've seen a bit of a correction here. Will this continue higher? I suspect so. And then if it goes the next leg from 1123 to about 1600, I think we're going to go into this range right here. Then we maybe see a bit of a consolidation back to the blue line and then back up to here. What we will see is a 5-wave pattern. It's an Elliott wave pattern. Technical chartists like to use it. Right now, we are in this first breakout. This is the first wave, actually. So this is wave 1 of 5. One wave up, which we're going to see here. A wave 2 correction. Wave 3 up. A wave 4 correction. And then a wave 5 parabolic move up over the next 2 or 3 years. And in those waves, there's also mini waves, 5-wave patterns, and then ABC correction. I'm not going to get into all of that on this channel. That might be for another video to talk about technical analysis and how to read the metal markets using technical analysis, especially on the miners. But what I am saying is, yes, this is a long-term bull market. We're in the sweet spot right now to look for the mid-cap producers. The junior miners are the next sweet spot, and then the exploration plays, they'll start later this year. Some are already doing quite well. I showed a chart on one that went up 300-400% on no news, but just a lot of inflow and buying on the stocks. There's a very tightly held share, and it literally went from under $1 to $4.50 or something like that in a matter of 3 days. So those are the kind of gains that you will be making in the right stocks, the right time, and the right management. A lot of factors I'm going to cover in another video very shortly. But yeah, this is where I love it. I think we're in this sweet spot. I'm very excited to be back into it again, covering the juniors and the exploration plays. I'll be covering a lot more of them on this channel. In general, I probably, I don't know, I may mention some individual plays themselves, but a lot of the individual research on the companies that I like will be covered in our newsletter. It's a subscriber-based newsletter, and I'm offering it. I just started writing it. Introductory pricing of $99 a year, and that'll be for a couple of more months, but then it'll go up to the regular price of $179 a year. So if you want, take advantage of the $99 price point right now. You can sign up on the Financial Liberties website itself. So that's it for the junior miners. I'm working on a video, hopefully for this coming week, and I'm calling it Junior Miner, the get out of jail free golden ticket they've been given. That's kind of the working thumbnail and the title that I'm working on right now. But like I had mentioned throughout this video, the metals rise first, gold first, silver second. We've seen that now. The mining stocks have done very well over the last year, especially the senior and major producers. The mid-cap have done very well as well over the last year. They still have some upside, but it's now the junior miner and the exploration is going to come after them, where that's the sweet spot, I believe. And that's where I love to be. And so this video that I'm working on is literally going to be talking about what I look for in terms of a junior mining company, in terms of management team, jurisdiction where they're mining, if they're funded, the capital structure, where they got funded at, who did the funding. I'm going to be talking a lot about funding because I think that's one of the most important factors outside of the management team and the jurisdiction. And it has the funding has a lot to play with it. What stage they are in terms of drilling, what stage they are in terms of mine expansion. Are they building a mine? How long are they gonna? Is the mine funded? How long is it gonna take to get built? When do we expect production? What hiccups they can go through? So we'll be discovering. I'll be talking about all this in the next video, which will be on the channel later this week. So look out for that. Yeah, this is a sweet spot. We're in it. I love it, and we'll be looking at the sector in general for the junior miners and the mid to small cap producers as well. So we'll probably start off with the mid to small cap producers, then the juniors, and I will talk about the exploration companies. Their cycle is coming, but the bigger upside, I think, is in the mid to small producers are expanding, and the juniors as well. So that stay tuned for that video. The last thing I want to touch is I do interviews with other experts in the space I've known from the last bull cycle. I did an interview with David Morgan a few weeks ago. It's up on the channel already, and we discussed the pricing of the metals market and silver in general. He's called the Silver Guru. He focuses on it. But we discussed the pricing difference between the COMEX, the LBMA, and the Shanghai Futures Exchange. Who sets the price? What's the clearing mechanism? And who's taking physical delivery? And the bottom line from that video and the major takeaway is the following. The COMEX is the paper market. That's where the bullion banks are short. They're short for a reason. And that is because they provide a service for hedging. I don't know if they really want to be short what they are, and they've been covering their shorts. I think by this March, they will probably have covered a lot of their shorts. So that's why the silver price has gone up and will continue through March. But once that short cover is done, will we see some more shorts initiated? Possibly. So let's see what happens in March, and we'll kind of see where the metals are then. But there is a role for the COMEX. There's a role for the bullion banks. There's a role for hedging. Hedging is done primarily for the producers to lock in pricing that stabilizes it so they can do, their capital raises, their financial forecasting, whatever. But a lot of producers are not hedged right now. The ones that are, I've seen, are out of Australia, and I think they hedge more for currency risk than anything else. The vaulting facilities hedge, the bullion dealers hedge. So there is a need for hedging, which is why we see the short positions put on by the bullion banks, because they're the ones that initiate the hedging strategy for the individual players that need it. LBMA is more of a clearinghouse, and then you have the Shanghai Futures Exchange, which is taking delivery. They're the physical buyers. Mind you, the US and the rest of the world are now physical buyers as well, but they set the physical price. So he does a great job explaining that, and I encourage you to watch that video. Finally, the last video I did that I put up last week, or a week and a half ago, I think it was with Jay Martin from VRIC Media. His family's run the Vancouver Resource Investment Conference, which is actually coming on this Monday, Tuesday in Vancouver, but Cambridge House as well. So I spoke at his conferences back in the day, as well as I spoke at PDAC a few times. But I had him on my podcast. He was gracious enough to share some of his information. His YouTube channel is The Jay Martin Show, and he's got over 250,000 subscribers and followers, and he's done over 2,000 videos over the last 5 years, primarily mining, but other sectors as well. So him and I got to talking about where we are in the cycle, what was the major drivers, talking about central bank driving the price of metals, and then the rest of the supply chain and all of the silver demand that's coming in. So we discussed where we think we are in the silver market. He put it as we're not even in the major leagues yet. I kind of think we're in the second or third inning. So if we take a 10-year time frame, we're 2 or 3 years into it. Well, that's my second or third year inning time frame. So we still got a lot of ways to go before we hit the 5th inning and take a pause, and then the 7th inning, take a pause, and well, we'll hit the 9th inning, and better hope we don't even go into extra innings, which I think we're actually going to do in this cycle. So it'll be like that last World Series game between the Dodgers and the Jays going into extra innings. I think that's going to happen in the metals and the miners as well. Him and I came to also an agreement that the miners are right now the sweet spot to be in, outside of even the metals price. We'll see some exponential growth in them. He focuses on the producers and the majors and stuff like that. But we kind of agree there's going to be a sweet spot coming in for the mid-size. Right now we're seeing them with the juniors as well. So he shared his thoughts on that. He even said that the gold miners right now, even though they've risen, are cheaper than they were a year ago, even though many of them have already gone up 200% relative to the gold price. So let me state that again. The gold miners right now are cheaper than they were a year ago, given where we are on the gold price. And why? It's because of margin expansions. A year ago, a gold miner might have been making $1,000, $1,500, maybe $2,000. Now they're making $3,000-$4,000. And silver is even more. So the average cost to mine an ounce of silver is about $20 to $25. And that's all in sustaining costs. That's a terminology used in the industry. And we'll discuss that in a future video. But if you've got, even on the cheap end, silver is a byproduct of other metal production, mostly copper, zinc mining, or gold mining. But even if your all-in sustaining cost is $20 and now we're at $100, you have a 400% markup on silver right now. The miners have gone up to 100 to 200%, but relative to the price of silver, these miners, even if silver does not move from here, the miners still have another 100% move ahead of itself, maybe even 200 before it catches up to the silver price, let alone all the other exploration or the other juniors and mid-sized producers they have. So this is why I believe there's, over the next year or two, the majors still probably have another 100-200% run to go ahead of it. Mid-size probably 200-300%. Juniors and explorations, all bets are off. The right junior, the right exploration, we could see 500%, 1,000% would not surprise me over the next few years. I'm not promising anything, but that's what I'm looking for when I evaluate these juniors. And that's what we're going to discover and cover on this channel, as well as the newsletter, as I had mentioned. So watch the video with Jay. And I'm going to kind of wrap up this live stream. We're almost 53 minutes into it. It's about an hour. So that's kind of my outlook on the metals, the price of the metals, what was been driving the metal prices, and where I see things going, as well as the mining companies and where I think the sweet spot is. So that's kind of it. If you enjoyed this video, please don't forget to like and subscribe. I'm planning to do a live stream twice a week, Wednesday evening at 8 p.m. Eastern Time, and Saturday morning, like today, at 11 a.m. Eastern Time. Pretty much the same types of topics. On each of those live streams, I'll go into maybe one major topic and then get into niche focuses on an individual topic of interest. Also, having Q&A from people are viewing live, or if people have submitted Q&As into the various online publications that I write on. You can follow me on Facebook, LinkedIn. I'm on Reddit under Golden Fortune is my Reddit. Even Financial Liberties, but the main traction right now is Golden Fortunes on Reddit. Follow us obviously on the YouTube channel and TikTok if you want, but the primary, where else you can follow me on is Facebook, LinkedIn, for Financial Liberties and Golden Fortunes, on LinkedIn. On X, you can follow me on Financial Liberties and Golden Fortunes, and Reddit, as I explained. And if you are interested, I am offering that newsletter. There's a free newsletter on our site, financialliberties.com. But there's also a subscriber-based one in the shopping cart you can look for. It's $99 right now. That's where I provide in-depth coverage on the mining sector, as well as the mid-cap, small-cap, juniors, and exploration plays. So I hope you enjoyed this video. Again, don't forget to follow, like, and subscribe. Leave a comment. Eventually, I'll probably turn this from a live stream into an actual video on the channel itself in the next day or two. But I hope you enjoyed this, and don't forget to join us on our next live stream Wednesday at 8 p.m. Eastern Time. Take care and enjoy your weekend. Take care.